Monday, May 18th, 2020, Maneco 64, home of alternative economics and contrarian views. So fiat currencies are continuing to melt down, and of course that's versus precious metals as central banks meld with the state. What does that mean? Well, it means that the illusion of central banking independence is quickly melting away. I personally never believed in that, how can I say, idea that central banks were independent. After all, central banking monopoly of issuing the legal tender currency is a state-given right through the law. So ultimately, they have never been independent central banks. They've tried to portray that illusion in the last 25 years. Just as a way to try to inflate the system even more, not only for governments, but for the bankers as well. And I think that's coming to a screeching halt, and investors are realizing that they've been fooled, that there is inflation, that the definition of inflation that we've been told these last 2 decades, that it's CPI or RPI or PCE, is just a sham. They've completely corrupted the word inflation. And I've said this many times before, inflation is a purely monetary phenomenon. Even Felix Sommery, a banker that was very well known in the early 20th century, the Raven of Zurich, he said that inflation was a purely monetary phenomenon, and that hasn't changed. And only the state and central banks can create inflation, because inflation basically is the counterfeiting of real value. It's the printing of funny money. And that, of course, leads to the dilution of the existing currency that you hold in your pocket. So that's what's going on. There is proof right now, of course, that central banks are acquiescing completely to the whims of government. And they use this excuse that CPI is going to zero, so they're not really helping the governments by buying all the new debt that they're issuing. It's just that they're trying to get CPI back to 2%. And I think that's very lame, because we know that all the things that we need to survive, especially the general public, and I'm not talking about the 1% or the very top. Everything that we really need is going up in price, or the pound or the dollar or the euro in your pocket is not buying as much. So I'll go through some of the comments by Andrew Bailey, who was interviewed last week by the FT. So this is what he says about the money printing that the Bank of England has started. They're printing now 60 billion a month. They just use the banks as an intermediary, so they don't have to say they're monetizing the debt. So this is what he says about the purpose of this QE. I'm kind of paraphrasing him here. He says, we knew there was going to be a substantial issuance of debt by government, and we, the Bank of England, knew that was going to strain the capacity of the market. Well, that's a euphemism, strain the capacity of the market. That's a euphemism to saying if we hadn't intervened, interest rates would gone through the roof. And that's because the real market can't sustain all this debt. Only the Bank of England, by making up the numbers, typing it on a computer keyboard, and buying this debt, has kept interest rates low. But the flip side of this is that the reputation of the Bank of England has been completely annihilated, in my opinion. Maybe not all investors have twigged onto it, but they will. Yeah, and he says that he needed to stabilize markets, and he gave the excuse inflation is dropping to zero, according to BOE forecasts. So he doesn't even use the real data. He says, oh, our forecasts are saying it's going to zero or minus 10%, so we have to print trillions, right? Yeah, so he uses that excuse that their forecasts see inflation going to zero. And it's quite a lame excuse. If you look back in the 19th century, when the Bank of England was probably more independent, a lot more independent than it is now, the national debt dropped after the Napoleonic Wars by 150 million pounds or so. I know it doesn't sound a lot, but it was a lot back then. And that was when there was still a semblance of sound money. And during that whole 100-year period after the end of the Napoleonic Wars and the beginning of World War One, the average price rise in the UK was like minus 0.1% a year. That was, there was no inflation because the amount of that actually shrunk in the system. So you can bet that things are not going to get better in terms of cost of living for you, the general public. And what about Jay Powell in the U.S.? Well, we know the Fed is almost up to 7 trillion, their balance sheet. They published it last week. It will definitely go over 7 trillion this week when they publish the numbers on Thursday. I would bet on that. And there's an article here today in the FT. Jay Powell warns U.S. recovery could take until end of 2021. I mean, I'm a buyer of that as well, but that's not what I'm here to discuss. I don't think this recovery is going to go anywhere anytime soon. It's not going to be a very good recovery, and it's going to take years for the economy to get back, if it ever gets back to what it was before this 2020 crisis. But the interesting thing he said here in this article, and I've highlighted it, it says, Mr. Powell said that while lawmakers had done a great deal and done it very quickly, Congress and the Fed may need to do more to avoid longer-term damage to the economy. That's another fallacy or non sequitur. The more the Congress and the Fed do, the worse it will be for the economy. And why do I say that? Well, because a free market economy needs to have small government, and it needs to allow the free market or the private sector to thrive. But what the Fed and the Congress are going to do even more is inflate the currency even more. The Congress will issue the debt, and the Fed will oblige by monetizing that debt. That means the private sector will be lumbered with more and more debt over the years or decades. The general public is going to carry that debt, that overhang of debt. It's going to crowd out investment in the private sector. So I don't see how Jay Powell sees the economy recovering by these actions. He says the Fed chair said fiscal policies that help businesses avoid insolvencies and that do the same for individuals would position the U.S. economy for a strong recovery post-crisis. Another huge Keynesian fallacy there, Mr. Powell. Have you ever looked at Iceland, what they did after the '08 crisis? You probably haven't, because Iceland allowed all the banks to fail, the economy to basically collapse, and they had a very fast recovery. What you are suggesting there will not help the economy recover anytime soon. You are blocking the natural free market from doing its job, from liquidating businesses that shouldn't be around, by saving businesses, by basically providing helicopter money for individuals, and that's going to be horrible for fiat currencies. And that's why I've come to the conclusion now that holding paper money or fiat currencies or national currencies is the most dangerous thing, I think, in my opinion, an investor or a saver could do. You need to be out of paper ASAP. And of course, precious metals are the only monetary alternative, liquid monetary alternative to paper money. well, they've been money and currency as well for thousands of years. What about cryptocurrencies? Yes, they will do well, but be careful with cryptocurrencies. They're not as stable as precious metals, and they don't have a track record of thousands of years. Bitcoin's been around for maybe 11 years. So there you go. Let's quickly look at the markets now. It's 8:30 a.m. London. So we've got spot gold right now is at 1760. So we're making a new high for the year here as we speak. It's up $18 or 1%. The high's been 1765 and the low has been 1740. I think that's where it closed roughly on Friday. Silver is doing very well again, which is a good sign. We want to see silver outperform gold in a precious metals bull market. We're not back to 100 yet on the gold silver ratio, but we're very close. Silver's at 17.29 here, up 66 cents or 4%. So as you can see, silver, when it goes, it goes. 4% is going to look minimal when you see silver really move higher. So the range has been 1660 to 1734. So we're right near the highs here in silver. The Dow futures is up today. It's up just under 1%. So it's keeping up with real money. If you look at the stock market in terms of real money, we topped in 2018 when the Dow Gold ratio was at 22. And really long term, the stock market topped in 1999 when the Dow Gold ratio was above 40. But that's another subject. So S&P right now is up just under 1% as well. And the NASDAQ 100 future is up 2/3%. What about the fiat currencies? Well, it doesn't matter which one you hold. They're all going to sink versus real money. They do take turns between each other to depreciate against each other. But the end game is that they're all going to be down the dumps. Sterling is at 121.08, unchanged. Euros unchanged as well, 108.16. And the dollar is also unchanged against the yen at 107.17. Oil continued to move higher. Why is it moving back up? Well, because they're reopening a little bit the economy. And I think we're seeing that the central banks and governments are going to do everything they can to get things going again. And that will completely destroy the fiat currencies. And even oil will have some value in that environment. So WTI right now is up 5% at 31.04. Even copper today is up. Copper is up about 2% at 237 cents. To finish off, let's quickly look at the bond market. The 10-year yield is unchanged at 64 basis points. So there you go. Don't believe the mainstream media or economists or politicians or bankers when they say that the central banks are independent. They're not. They're working together now with the governments to create as much debt as possible. And how are they going to pay for that? They always keep saying, oh, we have to pay for this. Well, you're going to pay for it through the inflation. And what that means is that someone asked me that the other day. What will it mean for the state pension or all the benefits? Well, let's say right now you get 160 pounds. I don't know what the state pension is exactly a week. Yeah, in 5 years' time you might get 200. But that 200 pounds is only going to buy 50 pounds worth of goods that you can buy today. And that's how they're going to do it. You're going to be paying for it. So one way to protect yourself is to have a few coins or bars of gold and silver. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.